Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 101. As always, joined with the three amigos. We got Keith Dicker, Ice Cap Asset Management, Rich Diaz, the Tom Brady of Macro. Welcome back to the show, gentlemen. Keith, what's going on, buddy? You got a new shirt?
I know. We if you're on the YouTube version, right? It's the one to watch.
Yeah.
You can see I have a shirt. And what does it say, Rich? What is the symbol on it?
It says CBDC. And then there's a big cross through it. It's like a no anti-CBDC shirt. What does that mean? What does that mean?
Say no to CBDC.
Say no to central bank digital currencies. So one of our good friends of the podcast, he listens a lot. His name is Eric out in Calgary. Eric sent this to me. Thank you, Eric. This is it feels nice too. I'm like Dougal from Father Ted. I haven't taken it off since it arrived. By the way, Dougal on Father Ted, he wore his Irish rugby jersey all the time.
Did Mrs. Ice Cap know what that meant? CBDC?
I'd like to say yes, but no.
Oh, boy.
Hey, guys, speaking... Oh, wait a second. I'm going to hog Rich's. Rich said he has nothing. He has a haircut, and that's it today, right?
That was offline. I told you I had nothing.
But your haircut looks good.
That was not for public consumption. Anyway, carry on.
Okay. This is something for Canada as well. So the World Cup of Rugby is starting today, maybe, or this weekend. So it's the Rugby World Cup. One of my best friends, my dearest friends, his name is Rod Snow. He's from Newfoundland. He's played in 4 Rugby World Cups. So in the Canadian rugby world, if anyone is in there and they touch it, he's a legend in that space. And he's played in 4 of them. Every time the World Cup of Rugby comes along, they always connect with him again. But once again, check out his name, Rod Snow. Say Rod Snow Rugby and look at the videos of this guy. He played 10 years pro in Wales as well. So big guy. Canada did not qualify for this Rugby World Cup.
No.
Yep.
What a letdown.
I know, but the top team, number 1 rated team in the world right now.
New Zealand.
No, it's the Irish.
What?
So,
really? Oh, I thought the All Blacks are always really good.
No, I think they're 4. They are good, but they're probably 4th. But anyway, Dougal from Father Ted is wearing his Irish rugby jersey for the next month. Just like me with my central bank digital currency shirt.
I want
Steve,
one.
How about you, Steve?
I don't have any special shirts here. We've got a jam-packed episode today, though. We've got, we're going to get into it. We're going to get into, we had Canada jobs numbers last week, so we want to unpack some sort of tidbits out of that. We had US CPI. We had Canada rental data. We got the ECB that came out with another rate hike. We're going to get to all that. So we got a lot of that, but before we get into all of that, we actually have a special guest interview for this week's episode. It's Ben Rabidoux of North Cove Advisors. For any of you that are not familiar with him, very, very active on Twitter. Ben runs a research firm that is focused on Canadian housing and the credit cycle. I think he's got some of the best research in Canada. And so for those that are on the institution side, portfolio managers, et cetera, he's got sort of an institutional level of research service that you can subscribe to. We'll have that in the show notes. But he's also got sort of I'll call it a dumbed down version for realtors and mortgage brokers. If you're in the industry, he's got a research service called Edge Analytics. I personally subscribe to it, and it's been awesome to sort of just have his guidance to really unpack a lot of nuances of the data. I think he's a chart master. Let's put it that way. And so we're going to be delighted to have him on this week's show. Ben, welcome to the show. Thanks for joining the Loonie Hour. The first appearance for you. Hopefully it won't be the last.
No, it's a pleasure to be here, guys. Thanks for the invite.
So we dive through a lot of your research notes here. I guess to kind of frame things up, I know you're really active on the credit side of things. What keeps you up at night these days?
Well, I mean, there's nothing that I worry about that I don't think is super mainstream right now. I think we're kind of in this period where interest rates have risen, but there's kind of this sense that the economy's been more resilient. There's been a bit of a cushion on the household side due to pandemic savings, and so we kind of been lulled to sleep that these rates, they hurt, but they're not really impacting the market. And I feel like that's just premature, right? I mean, rates at these levels are just going to break things. We have a highly levered household here in Canada, relatively levered corporate sector. Rates at these levels, you roll this forward any length of time, it's going to start to matter. And what's interesting is, so we just got some balance sheet data from Stats Canada. So Rich may have seen this, but this is really fascinating. If you look at, like, one of the data points that I track pretty closely is the household debt service ratio, right? Which is the share of household income that goes towards principal and interest repayment on debt. Super interesting data point because it correlates well with non-performing loans at Canadian banks. If you give it a lag, it correlates with kind of the more discretionary purchases. What we're finding is that ratio is holding quite stable. In fact, it declined slightly last quarter. You're like, well, how is that possible, right? And if you then take that indicator, you break it down into both the principal and the interest repayment component. It's fascinating. You've got interest costs spiking, and you've got principal repayment plunging. Right. So we're now at the lowest level of principal repayment. We're now below. So this is crazy. Principal repayments in Canada is now below where it was in Q2 2020 when we had all the mortgage deferrals. Right. Where literally people were like, the government was like, if you don't want to pay your mortgage, just don't pay it. And today we have principal repayment that's lower than that. And so, and the reason for that, of course, is these static payment variables, which is this kind of bizarre Canadian only construct that just has everybody confused. But it's masking a lot of the potential pain. And so the headline number is relatively flat, even as the interest component is spiking. And so what is going to matter is as we get into some heavier renewal years in 2024, 2025, as those mortgages renew, they revert back to the original amortization schedule. You're looking at a 40, 50, 60% increase in monthly payments. I just don't see how that doesn't end up being a real problem.
I got a question for you on that front. So if you're the regulator, you're OSFI, you're Peter Rutledge there running OSFI, how do you juggle this? Do you genuinely think do you think it becomes a large enough problem that OSFI or the banks, they have to figure out some sort of way to say, okay, you're supposed to get back to your original amortization schedule, but we're going to kind of tweak things a little bit, give you a little bit more leeway? Because I agree with you. People are going to have these massive balloon payments. And if you start multiplying that, what is it? 20% of some of these banks' books have amortizations growing north of 35 years right now.
Yeah, north of 20% in some cases. Yeah.
Yeah. So if you're a betting man,
what can they do? Well, so they can't solve the problem completely. What they can do and what they probably will do is allow them to re-extend the amortization, right? So right now it's a tricky situation because if you want to re-extend your amortization at renewal, you technically have to break your mortgage and you have to create a new mortgage. But in order to do that, you then have to stress test it. And so you've got this situation where the people who are most vulnerable and most impacted can't clear the stress test to refinance their mortgage into a longer term. Now, there's a pretty easy solution there. OSFI just says, we'll allow them to re-extend it. Now, that's going to help with the margin. So maybe instead of going up 50%, your payments go up 30 or 35%. Like it's not a solution, right? And then you're into other issues around how do you force the banks to provision for those, right? Because clearly in my mind, that's a higher default risk, right? So there's no free lunch in this. Ultimately, I think the answer is just if rates stay at this level, it's going to be painful.
This really comes down to the inflation side. Keith, I'll let you chime in here, but I mean, I'm kind of curious, Ben, we got sneak in a question here, but on the inflation side, so you look at all this, you look at the highly levered Canadian consumer, and the one thing, at least I'm wondering, and fair enough, I've been wrong on this for quite some time now, but I struggle to see a scenario where inflation holds up when the Canadian consumer, which is 65% of the economy, has really no staying power, which is, they're clearly starting to delever. And so how are you going to drive excess demand and inflationary, other than supply issues. But I'm struggling to see how you get sustained inflation if the Canadian consumers is choking out on their mortgage payments.
Yeah, no, I think you're probably right in that situation. Like what the situation that I'm painting is certainly one that will necessitate a response from the Bank of Canada, right? So yeah, I think it will be negative for inflation. Like we will see downward pressure on inflation if you see substantial stress at the household level, right? There's no question. But I'd leave it to Rich. Rich is way smarter than me. He's probably modeled all this stuff out in his extensive spreadsheets. He could speak to this better than I could.
Oh God, no! Models never call me back, so I'm not a big fan of them. But I will jump in there for a second. So thanks for joining us, Ben. I really appreciate your work on Twitter, and I know we connected a little bit, hopefully more in the future. My question is, what you're outlining is sort of a scenario. And forgive me if I'm getting ahead of here, but what you're outlining is a scenario is that if people just hold on tight, that the Bank of Canada will see sort of disinflationary pressures and do what I think is priced into the US market and start cutting sort of before the beginning of next summer, thereby restarting the Ferris wheel and just starting this whole thing again. Do you think that they'll cave? Do you not, or do you think they've learned their lesson, or how do you think this sort of plays out over the next 12 to 18 months? I know that's a tough question, but I'm curious.
Well, look, I'll take a kick at it with the caveat that I, certainly didn't see the magnitude of the rate hikes that have happened. So
fair enough. Neither did I.
I mean, who did, right? But what I would say is I think, look, central banks are always afraid of making the last mistake. They're always fighting the last battle. I'm not calling for a return to zero rates. In fact, I think even in a recessionary environment, we maybe get back down to the Bank of Canada rates with a 3 handle, which still implies that you're looking at mid 4% fixed rates, right? So to me, that's the new reality outside of a true financial crisis, in which case we know central banks have exactly one playbook, and it's cut to zero and QE, right? There's no reason to think they'd be different this time, but I think we're in a fundamentally higher interest rate regime, and I'll be honest, I think mortgage rates in the 4s are enough to take a lot of steam out of this market, right? Now,
well, so that you beat that was my next question. Sorry to interrupt you, but that was my next question. So please carry on.
Well, I think it's important to contextualize this. If we look at Toronto, right, home sales in Toronto are at a level right now that was last seen on a sustained basis in the 1990s. You could argue that it's unsustainably low. Right. And so would mortgage rates, if mortgage rates went back to 4.5, would we see an uptick in demand? Yeah, you would. For sure you would. There's well-qualified buyers that would come off the sidelines. But I don't think that fundamentally brings us back to this rip-roaring, insane market that we've seen over the last few years.
I mean, I've been making the case for, are we entering a period of no growth in Canadian housing? Or I mean, for pockets of the market, at least for the next decade, right? I mean, we saw it in the 90s. Maybe the GTA goes through 10, 15, 20, 20% correction and then just kind of
we're already there, Steve. Yeah, well, we're there already, right? You look at most of the metros in Southern Ontario have been hit the hardest. We've still got metros that are down 20% from peak, right? Including some of the suburbs around the GTA. So, I mean, that magnitude of correction is already historic in the context of kind of the 50 years of solid house price data that we have. And I don't think it's probably not done yet, right? I mean, if we look at what's happening in these markets, like it's a weird time, right? Because there's legitimately a shortage of inventory. Like you look at what's happening in the resale market, you're still sitting in inventory levels that are a little more than half of the normal levels going back over the last 15 years. So there's not a ton of inventory on the market, right? And yet we're seeing that prices and sales are still significantly under pressure, right? So I mean, I don't know what all that means, but I think that what we're going to see over the next few months is a substantial increase in new listings coming to market, because there was certainly a sense for most of the past year that if people just held off, that interest rates would fall and everything would be all right. And I really get the sense in the people that I'm talking to on the front line that the sentiment and the psychology really broke this summer with those 2 back-to-back rate hikes. And now we're starting to see some level of capitulation, particularly among these deeply cash flow negative investors. And that's starting to manifest itself in rising new listings, finally in an uptick in resale supply. And so I think the direction for pricing is down from here. But let's be really clear. Like, this is already a fairly historic housing downturn in the Canadian context.
So I'll just jump in here as well. Yeah, a couple of things, just to sort of simplify, because some of our listeners, they're at a sort of a different level than what the conversation is taking place here. But what we're hearing so far is that there are a lot of people with mortgages where they haven't been able to pay down principal over the last X number of months. That mortgage is coming up for renewal within, I think you said 2024 and 25 were the big years, I believe, Ben, in your last report. And then when that comes, that's going to create stress for everyone. And what I mean by that, really, it creates stress in the banking system. So we're looking at this, it could be a stressful moment coming up. But let's just walk through a scenario where, hey, what's the best case scenario coming up? And the best case scenario is that supply is able to increase, but it's not like SimCity. You just can't hit a button and it's going to go up dramatically. But if we do continue with a strong economy and strong population growth and all that, or even if population growth stays flat and the economy stays strong, we're still going to get higher rates going up. So the long end of the curve should increase. The short end of the curve, what I mean by that, long-term interest rates will go higher. So people with, a 5-year term opportunity coming up, that's going to pay more for that. You will also have variable rates. They likely won't come down because the Bank of Canada they won't be cutting because the economy is doing well and so forth. And so in my mind, we're still not any better off because it's going to become more expensive for, the average person to either renew or to afford that house that's still going up in price because of, the supply challenge. So give us a better outlook than that. Like how does that not happen on the rosy side?
Yes, you want the bullish scenario, right?
Well, that was bullish, I thought, but
well, look, how does it go right? I think it's hard to overstate how significant population growth has been in Canada and how much that has driven marginal demand. And so Rich and myself, and I think, Mike Moffat at Western and Mikhail Scooter at Waterloo, I think we were like the 4 original gangsters on the whole non-permanent resident file, kind of banging the drum on that. And just to be clear, so if you look at population growth in Canada, it was 1.2 million over the last year. That's a 3.1% growth rate. It's about 6 times what the US is seeing. I mean, it's massive. And if that continues, you can only fight that level of growth for so long. Like I think, so the way I'm thinking about it, Keith, is like, we've got this period of time where if what we're seeing right now is the status quo with current population growth, the lack of new supply, you've got a period of time where interest rates are going to drive the bus, right? And it's just hard you just can't fight 6% rates. And so maybe that's a year, maybe that's 2 years. Like, we don't know how long that takes for that to work its way through. But eventually you're going to get into a situation where the longer term supply demand dynamics will begin to exert themselves. And you could see a scenario where it very quickly reverts back to the strong sellers market at the other side of it. Now, what I would say is I'm not at all a believer that population growth is going to stay anywhere near current levels, which is something we can explore if you guys want. But I think that a year from now, we will look at population growth that's at a minimum cut in half from current levels. So we will go from adding 1.2 million people to adding 600,000 or less within a year. I know that's a very out of consensus call, but I think that's like a layup right now.
Walk us through that.
Wait. So, but that, okay, go ahead. Because that's partly a base effect thing, but that doesn't affect the supply dynamics of the housing. Do you know what I mean? Sorry, Carol.
Oh, you're absolutely right. It is a base effect thing, right? And so this is the thing. So it's first important to kind of disaggregate that population growth number. So you got 1.2 million of that. You have about 450,000 that's permanent residents. We bring in, call it 500,000. We lose 50,000 people who go to Costa Rica and never come back. And so it nets out to like 450. But the big one has been non-permanent residents, which are primarily international students and temporary workers, right? And that has added 730,000 in the past year. Now, when you plot that out going back to the 1960s, we've never seen a rate of growth anywhere near that. I mean, it is absolutely off the charts. And if you look back at any prior recession, non-permanent resident cohort, not only does it drop to 0, it always goes negative in a recession, which kind of makes sense because the programs by their nature are defined, they're designed to flex with the needs of the labor market, right? And not only that, you also have a situation where Canada just inherently becomes somewhat less appealing if there's no jobs for international students after graduation. And so these programs are highly pro-cyclical. So if we get into a situation where the economy slows modestly, you will see those numbers drop to zero, right? Or negative. But let's just assume they go back to the long-term average of 50 to 100,000 a year. Well, as soon as you do that, you cut population growth in half. Now that doesn't, to your point, Rich, it doesn't immediately solve the problem, but I think it takes a lot of the wind out of the crazy rental market that we've seen over the last couple of years, just as an example, right? Because those non-permanent residents overwhelmingly are renters. It's created all sorts of dislocations in the rental market. It's incentivized speculation in the single family market where you can buy a home in Toronto and you can jam, 15 international students in there and charge them each $500. Like this stuff's happening in Canada. It's crazy. And so, you cut that dynamic off at the knees and the population growth looks very different going forward. And I think that's where we're going.
I want to jump. Jump in front of Rich for a second. Yeah.
Go for
it. Share with me, Ben, what the annual number is usually like for the international students coming in, and just to add on to that, are they capped by numbers from Ottawa or from the provincial sector, or is it each university? Because as we all know, every university needs operating funding to their operating budget from provinces to keep going. And the margins on international students are probably 5x local and out of province. So how would the flow of international students slow if it's just universities that have to make that decision? Because if they have to make the decision, they won't. They'll gladly go international all the time. So when you do roll into any of these, university towns, like I am now here we go. People that can't see this, I have a University of Waterloo dad mug. That's where Junior is right now. But you go to any of these towns, and as you say, the rental market is through the roof.
Crazy
because of that growth. So answer that.
Yeah.
Awkward
so I know
number
where you're
of
going
questions.
with that. So the first part is what does it normally look like? So Stats Canada does a good job of breaking out non-permanent residents as a group, but within that is lumped temporary workers, international students, and refugees. So it's difficult from the official Stats Canada data to disaggregate that. We can look at, for example, international student admissions. That doesn't capture the outflows, so you're only getting the people that are coming in. And I mean, it looks exactly like you would expect. It's literally a hockey stick. It's kind of bumping along. I don't know. I'll probably butcher the exact numbers, but call it 300,000. And in the last couple of years, it spiked up to 900,000. So, I mean, it's just an enormous boom. Now, okay, to your question, how do the feds unwind this? What I'm learning is there's a fairly complex web of regulations around this that capture both the provincial governments and the federal governments. There are things that the feds can do to significantly curtail that dynamic. So, for example, they can significantly increase the price for application for the international students. They can cap the working hours that they can do outside of school. Like there's things that they can do to kind of disincentivize international students. But to me, okay, so here's where I think this is going, Keith. So what I'm learning is when you look at the colleges, I'm going to zoom in on Ontario for a moment. We have a number of colleges here in Ontario that have 80% of their enrollment are international students. Now, what's happening is you've got publicly funded colleges that also have private-public partnerships with for-profit educational institutions. And so the college rubber stamps the admission and then outsources the teaching to a for-profit institution. Now, I went and pulled up the articles of incorporation on one of those, and it's a major one that has thousands of international students in Toronto. It is an international student-only campus, and two of the three founders are from mainland China. And I think what we're going to find as we dig into this, if we can get beneficial ownership of these, is I think you'll find a situation where you have, for example, senior administration at the colleges that also own an economic interest in these private-public partnerships. Like, it's just a toxic dynamic. And so my point is, the incentives are misaligned. And I think as that comes to light, there will be tremendous pressure on the provinces and on the feds to curtail that. Now, let's remember, they've tripled these numbers in a couple of years. The universities and colleges were fine a couple of years ago. I mean, they weren't fine. They had some funding issues, but it's not like this is going to be catastrophic. We lost Laurentian university here in Ontario, it's not the end of the world if we have to lose a few colleges because they can't fund themselves without.
Wouldn't it be awkward though if we also found out some names in Ottawa were also shareholders of these
I can't
corps?
wait to try to figure this stuff out.
Let's let Rich is just dying to say something. What do you got, Rich?
Well, because this is the thing. Your point about pro-cyclicality on the immigration and the temporary workers thing, I think, is spot on. I think you're right on the base effects, and I think it was important to add that. But I think, if I may, you've highlighted why I think at this time is different. Famous last words, and it is that student component. It's the student component that is not, I would argue, pro-cyclical. The gentleman who owns this public-private partnership, he is not necessarily, like, whether or not you study calculus 1 or whatever it is, that specific action and that incentive from that student to come to Canada to do that schooling and then ideally, hopefully for them, get a secure PR, in my view, is less, let's say, pro-cyclical than it has been in the past. And if you have those numbers as high as they are, given the small inventory, it does keep that upward pressure on the rents. And that rents keep up upward pressure on inflation, right? We know it's a huge part of CPI. And so that's where I think, and then again, sorry, this is circular and I'm going on, and I'd like to hear your view on this, which is like why I think, again, it is different, and why I think that the Fed, this idea that they will cut interest rates again next year or what have you, I think is again, you're squeezed. And I think that you've articulated that the temporary employment and that student visa program really, really well. And I'd like you to elaborate more on that if you can, but just, isn't that different?
Well, potentially, but I also think, like, I want to be clear, I'm not blaming international students. They've been sold.
No, it's not their fault. No,
right?
it's a racket. It's a racket.
It's 100. Well, you nailed it right there, Rich. It's a racket. And these same private-public partnerships are over marketing this in other countries, especially India. And they are selling false bill of goods. Now, we've got international students literally sleeping under bridges in this country. Like, do you think that once that word gets back, that
okay, that's a fair point.
Like, do you know what I mean? Like, it's just, if this is the actual living conditions that we're expecting international students to live in, you think we're still going to be admitting 900,000 in a year? Like, maybe I can't see it. Like, at some point, the Canadian dream dies, right?
Which brings us back to the housing file. Ben, as of recording this, so yesterday, the federal government, of course, has said, hey, we've got our first participant in the Housing Accelerator Fund. It took 18 months, so not very fast. But so you got your first. So the government is starting to panic, I think, with the polling. Today that we're recording here, they just announced that they're going to remove GST on rental buildings, which is a huge announcement. They've had a lot of...
That's like the first thing they've said that could actually move the needle, by the way. That's actually some smart policy that could actually move the needle on this conversation.
And I'm curious...
legislation.
No, so you're saying it took the Accelerator Fund 18 months to accelerate a plan to make
not
things
much of an
better?
Acceleration.
It's just an observation, guys. That's...
Yeah. So anyway, yeah. So
listen,
I mean,
okay, so here's the thing, Steve. So they just announced that they're going to remove HST on rental construction. I just posted a chart on Twitter showing what rental construction looks like in Canada right now. And I mean, so we've got, what's the exact number? 130,000 purpose-built rental units under construction right now. That's a record by a substantial margin. It's not like the development industry isn't trying to bring supply to market. My point is, you're never going to build enough to accommodate 730,000 non-permanent residents. You don't have the manpower. You don't have the, like, you don't have the cranes available. Like, it's insanity. So to me, look, this is a smart policy, but it's not going to move the needle unless they also deal with the demand side.
Yeah, I mean, I think that's a good point. I was also curious just on the supply side, if even with removing the GST and having these accelerator funds, is it going to be enough to sort of counterbalance the cyclicality of, hey, listen, cost of borrowing is up, 2-3x on these massive development sites. Your cost of construction is still very elevated, and the numbers are just incredibly hard to pencil. And so you're seeing a lot of developers obviously pull back. I don't know if you want to get into, you got some research on building permits, but that's kind of your forward-looking indicator of future housing supply.
Yeah, well, this gets back to the point I made. I could very easily envision a situation where we go from a housing downturn to snapping back to a very tight resale market on the other side of it. Right. So this gets back to the point, like at different points in the cycle, different dynamics are kind of driving the bus. And right now it's clearly interest rates, and you don't have to overthink it. Interest rates at these levels just do not work. They don't pencil. But you get beyond this, and whatever time that takes, I think we set up for a situation where the resale market is dramatically tight if we continue with these current trends of population growth and a lack of new supply. So the concerning thing is, to your point, if you look at building permits, they have been quite weak, especially single family. Now you have to be careful because there's a lot of noise in that data set because you have big apartment units, for example, and typically those pre-sell a year before they get permits. And so the permits that you're seeing today oftentimes are reflecting pre-sale activity a year ago. So the better signal within that data is the single family component. That gives you a better indicator of a real-time demand, and it's plunging, right? So you roll that forward 6 months, we're going to continue to see a significant slowdown in construction activity. And ultimately you roll that forward a few years and it's going to be a lot less new supply, which, I mean, if that coincides with a bit of a normalization in monetary policy, probably Rich doesn't like that term, but if rates are coming down at the same time, it sets up for another kind of supply crisis if nothing changes.
I have one more question for you, Ben. What are your, I guess, non-Canadian network people, clients saying, or how are they reacting to this view on the Canadian marketplace that we're talking about?
Well, so it's interesting. I've worked with international clients, primarily family offices, sovereign wealth funds, pensions, and hedge funds, and I've seen like there's a cyclicality to the interest, right? And so my experience is they kind of tend to move as a bit of a herd, right? When they're chasing a theme. And what's fascinating is it's not very much on their radar right now. I think that there's just so much happening globally. There's so much stuff, so many interesting, as you know, Keith, I mean, you live in the macro world. This is a fascinating time. There's so much to do that why do you want to come to Canada and try to like take a swing at a Canadian bank that's been a widowmaker trade for a decade, right? And so I don't see the level of interest that I would have expected given the stress that I see building under the surface.
You get through a bit more of that stress. You've flagged insolvencies as well. I'm kind of curious to parse through that data as well.
Well, it's exactly what I post on Twitter. We're seeing a significant increase in insolvencies. Now, you have to normalize because we're still not back on the consumer side. We're not back to pre-COVID levels, right? So we started from such an absurdly low level that the year-over-year numbers look quite stunning, but we're still not even back to kind of normal levels of insolvencies. Different on the business side. We're starting to see a lot of stress on the business side. We are back to basically decade highs for insolvencies. Now, what we are seeing, though, this is very fascinating. I spoke to an insolvency trustee in Toronto just last week, and he said that they just had their busiest August. So this is a weird thing. There's seasonality to insolvency filings, which you would not think. You'd think if you're in trouble financially, you're just going to file when you're. But they said, no, nobody ever files in December because that's Christmas time. And nobody files in July and August because they're out having fun and getting into trouble, and then they deal with it later, right? And I said, that's crazy. But they absolutely said there's seasonality to it. Now, what's interesting is this year, August was the busiest year for insolvency filings so far this year. And that's the first time they've seen that in 25 years. And so they are getting the sense. It gets back to my point earlier where I think we saw something break this summer with those back-to-back rate hikes. And I think we're just starting to see it in the economic data. And I think it's going to get a lot worse.
Yeah. See, the problem with that, though, is like, sorry, I'm going to jump in. The problem with that is like, it's something I've mentioned before, and it's, it's like it's the Cobb Douglas function, which is like something a very macro nerd thing to say, but basically you have the number of people. It can be used in different contexts, but in this case, it's like your total factor productivity of each individual times the number of individuals in your economy basically make up your GDP. Okay, I'm screwing that up, but basically that's the concept. And our total factor productivity is 0 in Canada. Not quite 0, but let's just say 1, so times 1, and then our population growth is really, really, really high. And my point is, with a little bit of nominal GDP growth, it can solve and paper over a lot of things. And now, what you're suggesting, Ben, is that it hasn't been enough nominal GDP growth, right? Is that sort of what I'm trying to get, just from a top down?
Yeah. So there's an element of that, right? So when you look at the headline retail sales numbers, you're like, oh, it doesn't look that bad, but you adjust it for population, it's deeply negative. We're seeing, per capita household consumption expenditures are declining at the fastest rate, really, since they're at recessionary levels that we've only seen really in 3 other prior deep recessions. So on a per capita basis, you could argue we're already in recession in Canada. That's the nominal GDP growth is absolutely masking some of this. But I think the other thing is the pandemic savings was a real thing, right?
Yeah.
And the Bank of Canada had great data on that, where they showed if you break it down by income quintile, I'm probably going to mess up the numbers, but directionally this is correct. It's like the top income quintile had 4 months of liquid savings going into the pandemic, and today has 10 months. And then it scales down, and at the lowest income quintiles, there's zero, and it's just always been zero, right? But the point being that there's still some pandemic savings sloshing around the system. Now, what we're starting to see is that's getting worn down. So if you look at savings rate, and then you adjust for mandatory pension contributions, which I don't really consider savings. Like, it's not like you can ask CPP for your contribution back if you run into trouble. So strip out mandatory pension contributions, and we're starting to see some downward pressure on those savings rates. And I think that's indicative of consumers starting to hit a wall. And it could take a little while longer to burn through that, but that's another big factor that's kind of masked that underlying stress.
I think we found a new pickup line for Rich. Cobb-Douglas paradox. What did you call it?
Function. It's Cobb-Douglas function.
Cobb, try that one out the next time you go. Wherever you go.
I'm going to a concert tonight. I'll try it out tonight.
Ben, what's got you the most concerned? I mean, I'm kind of thinking like of a few things, which is like, okay, is it the B lenders? Is it the private lenders? We know that space has been growing exponentially over the last 5-10 years. Is it the pre-sale space? These people that speculated.
You got it. It's the pre-sale space. If you said what's the one area to watch over the next few months where we're going to get some nasty Bloomberg headlines, you give it a month and you'll have a lot of people talking about the issues in the pre-sale space. So let me give you some numbers. So we got 80,000 condos under construction in Toronto. I was talking to Jordan Skrinko, who you probably know. You follow him on Twitter. Great guy, super plugged into pre-construction. Yeah,
he's awesome.
So I put this in. I was like, "Hey, you got 80,000 condos under construction. How many of them were bought by investors?" And he goes, 80%. So I said, "Okay, let's call it 65,000 condos under construction that were bought by non-end users." So then I said, "Well, how many of those do you think will have issues closing, either because they can't afford the mortgage, or the property does not appraise, and so they effectively get a capital call to close on that deal?" And he goes, probably half of those. So I'm like, you're talking like 35,000 condos that are going to be completing in the next few years that are going to be quite distressed. Now, that's like 2 to 3 years of resale demand at current levels of demand. I don't know if that gets absorbed easily, right?
It does, though. It does when you have 700,000 students, not half of which are coming to Toronto. This is, I think, the part that I think, a lot of these companies, sorry to jump in there, but a lot of these companies will just reincorporate as a multifamily residential center and sell, instead of taking a 50% haircut on these condos, they'll just take a 25% haircut or 10% or refinance with these cash flows at 95% occupancy. You know what I mean? Like, I think that's
harder than you think it is, Rich.
Okay.
What are you saying, Rich?
He's saying that these condo corporations could effectively just close as a purpose-built rental. And
it's really hard to do.
And pay the loans. I think that's tremendous.
I mean, I am out of my lane here, but I think this could be absorbed, right? But if you're asking about things that are going to be interesting and headlines, this is one that's not on Bloomberg yet. You give it a month, there's enough distress there, enough like it's starting to hit the fan in that space that I think you'll see an article there. Look, who knows? This market's been much more resilient than I think any of us would have expected. So maybe that gets absorbed, but that's a lot of supply. We just have not stress tested this market to any extent. And it's proving to be highly, what's the right word? It's just the pricing is highly volatile, right? Like even in a low inventory world, what we're finding is the moment you add any inventory to this market, like Toronto's got like 2.5 months of inventory and the condo prices are under significant pressure. What happens if it hits 3.5 or 4 months of inventory? That's not a lot of inventory, but we're finding that it's just, that inelastic supply cuts both ways, right? And we're finding that you can find easily prices down 20% in that space.
I find the pre-sale market to be very interesting. Like even I know Toronto's similar, Vancouver, but like people just have this element of like they love to speculate on this like call option, which is put down 10, 15, 20%. But if you actually try to assign them, like once they're out of the preset presentation center, they're incredibly illiquid. And then once you actually close on them and try to resell them for like whatever price you paid, a lot of, I think now we're starting to see there's no profit. But people sort of, I find that people are still going back to the well and speculating on the pre-sale side, which is really interesting.
Not so much in Toronto. Like, we just had a 25-year low in pre-construction sales last month. But certainly in Calgary, right, which is a bit in your wheelhouse, there's a lot of speculation there. But you made an interesting point, which is that a lot of these assignments are no longer money good. And the reason for that is a lot of these pre-construction condos were sold at 30+% premium to resale market in Toronto, which is really the big issue in all of this, and gets back to what you were saying, Rich. Like, if you penciled in certain prices on your pro forma and the banks have lent against that, when it comes time to repay, like it's not easy to just, there's not an easy out without selling those and repaying those development loans.
But I can, like, even if you have a pre-sale assignment that's like you're going to resell it at like market value or resale value, I still find even those are very illiquid, because the reality is like there's, the presentation center is closed. It's been closed for 2 years now. And people don't want to just, you're asking someone to come in and buy a piece of paper. They can't walk around the presentation center. They don't get all the glitz and the hype and the, the developer sales team pitching them on it. It's just, hey, you want to buy this piece of paper? And most people will go, well, no, I'd rather just participate in the resale market. I need something that I can tangibly walk through. So I just find in general, and then like Ben, to your point, if you add on a 20 or 30% premium to that assignment, the good luck.
Yeah, it's going to be interesting. I don't know how it plays out, but what I would say is we've never stress tested this market like this, so we'll see. Do
you have much concern on the B side?
It's funny. Like, I would have thought we would have seen more issues there. So you're seeing non-performing loans at Equitable and Home Capital. They're certainly moving, right? Like, they were 15 basis points a couple quarters ago. Now they're in the 40s. That's not really that much given the magnitude of the renewal shock. And for Rich and Keith, like, just to frame it for you guys, if you're renewing, let's take Equitable Bank. So EQB is the ticker. If you're renewing a 2-year mortgage with them today, you're seeing your rates go from, call it 3.5% to 7.5%. I mean, that's immense pain. And you got to remember, their non-prime book has a weighted average duration of about 1.5 years. And so this is a weird thing in Canada. All of our non-prime loans are 1 and 2 year terms, right? So you have like risky bullet loans you got to roll. And in spite of that, which I would have said, like, that's an impossible number for a lot of these borrowers. I mean, 40 basis points of delinquencies, like, isn't that much. So I don't know what to say there. It's hard for me to imagine that you won't see more pain there, but they've proven remarkably resilient so far. But we'll see.
Just time,
that brings us full circle. That brings us full circle to how you started with this, which is like, a lot of us have been sort of on this debt servicing, and the consumer and household purchases are going to get bitten, and it's taken frankly longer than I certainly have thought it would. And isn't that just another sort of case where you can survive? You can roll over the bullet loan once at 7%. You can, beg, borrow, and steal, and maybe, but doing it twice, 2 years at 7%, 3 years at 7%, when you have no, price appreciation to refinance or whatever. I mean, isn't that sort of what we're sort of dealing with here a little bit? You're bang on.
So I think there's I think it was Lynn Alden that quoted the term that she said, the area under the curve, right? And the idea is at this point, it's not really a question of how high rates go. It's how long they stay elevated.
Yeah.
Right? Because you're absolutely right. People can float. And the one thing I hear from insolvency trustees that's consistent is they say someone will walk into their office and they're like, this person is dead in the water. They will 100% have to file. And they said that person will walk out of their doors and they'll be back a year later. And they're like, how did you even make it work for a year? But Canadians are remarkably resilient, and we can tread water and beg, borrow, steal, whatever it is, for a year or who knows how long, but eventually those rates start to break things. And I think that's exactly where we're at.
Can I ask one last question? Just something that the US had to deal with in their housing bubble was, and in Spain and in Ireland, was the issue of negative equity. So effectively, if I'm going to screw this up, owing more money than the house is worth, yep. Right? Is that an issue in Canada? Because I feel like it's just something I never read about or never hear about. And why or why not?
Well, it's not an issue in that prices have risen so much in recent years, right? So it will be an issue going forward, especially among the insurers, where they insure a much higher loan to value ratio. And interestingly, on that point, we just had word last week that one of the private mortgage insurers has stopped reporting the share of their book that is underwater, which is an interesting tell, right?
That sounds like 2008. Sounds like a gully.
Right. But, you know, there was a great Fed report that found that, because I know a lot of people will say, well, you know, Canada is by and large, we're a recourse nation. And so that's going to prevent a lot of people from walking away. And what the Fed paper found is that there was very little difference in the states that were.
I've read this paper.
And what really determined it was the level of equity and whether they had any other financial assets at play. And that's ultimately, I think, what matters. You cannot squeeze blood from a stone, right? And so recourse matters in as much as you have equity to seize. It does not matter once you're deeply negative. But anyway, on that note, I got to tell you guys something related to Twinkies. I got a crazy story for you. So I had a roommate in college that would used to take Twinkies and he would pan fry them with a little bit of butter so that they were like crispy on the outside and kind of like warm and gooey on the middle. I know.
That actually sounds pretty good.
I think it was surprisingly good if you can get over the fact that you were eating a fried Twinkie. But there you go, guys. For the next one that loses a bet, try frying it before you eat it. Maybe it'll make a difference.
That's actually hilarious. On that note, big news, Ben, while you're on the show, JM Smucker actually acquired Twinkie maker Hostess in a $5.6 billion deal. So
wow.
There you go.
Well, I hope they don't change anything for you guys. It'd be a shame to lose that tradition.
Fried Twinkies. Ben, we want to be respectful of your time. It's been a pleasure having you on the show. Hopefully we'll have you back on. Do you guys have any parting last words, Keith, Rich?
I have loads more questions, but I guess we have to go.
Well, yeah,
it's okay. Thank you very much, Ben. I really appreciate it.
Thank you, Ben. I really enjoyed our conversation.
Yeah, thanks, guys. Keep up the great work. I love the show.
Thanks, Ben. I thought that was a great conversation there with Ben, and like I said, we'll hopefully have him on again here soon. You know, one of the
was
things
that interesting? You know, I get to listen to. There's three nerds and a cool guy, so I love listening to three of you guys. It was fun.
Yeah, it was. One of the things we didn't mention on that was just, you know, continuation of the Canadian deleveraging side. So this is from Ben's own research. The 3-month growth rate in residential mortgage growth is running at its lowest levels since the 1990s. So clearly Canadians are starting to delever, and credit card balances are I think at all-time highs. So we'll see the last gasp from the Canadian consumer, which kind of brings us to last week. We had jobs numbers in Canada on the immigration side. Again, we didn't get too much into this in our conversation with Ben, but what we're seeing right now, you know, the headline jobs numbers, Keith, you'll like this, you know, everybody goes, oh yeah, they look pretty good, you know, not so bad. But they're actually not keeping up with immigration. And so per some of RBC's own report, we pretty much have to add about 50,000 jobs per month to actually keep up with levels of immigration. And right now we're averaging about 25,000. So just keep
I
that
missed
in mind.
that. No, it was good. You caught me.
But
there.
it's the classics. I mean, it's the slow boil. You know, I think right now, you got that frog in the water being boiled analogy happening with Canada and the economy.
Wait, what happens to the frog?
Blah. Is that a good ribbit? They die, man. Like it boils and all that other stuff. But I think that's what's happening right now. Because we that was a great conversation with Ben. There's a lot of energy in the conversation, but if you really want to summarize is that, boy, there's a lot of stress out there. And what is the relief valve for that stress? Because it does. I'm a firm believer we're not going to have a normal cyclical downturn and recovery. I think a downturn will accelerate into something that's going to be pretty freaking bad, and we need to be prepped for it.
Anecdotally, I've had 3 conversations in the last week and a half, just about Canadian households calling in saying, hey, this is my situation, and I'm up, Schitt's Creek without a paddle, and what do I do? And it's basically just been, my mortgage payment's gone up this amount, or my investment condo's gone from negative cash flow $100 to $900, and I'm at the point where I'm looking now for options. And it kind of comes home to Ben's earlier point, which was like people that are going into these debt insolvency firms and still managing to hang on for another year before they actually come back in and actually do something with their situation. I think that's what we've seen in part of the housing sector is like, people saw rates going up, a year ago and saying, oh, well, it's not really a problem right now. And I think just a lot of people in general with their own household finances aren't necessarily proactive, and they'll let it go until it reaches a point of no return. And I think it's very, very early days, but I do think I'm starting to at least get on my phone more phone calls. And I know chatting with other brokers and people in the industry that they're getting more calls. Again, not an overwhelming number of calls, but the calls are increasing about people that are in dire situations with their mortgage situation.
And that's with this period now with no recession. I know technically we can say how we're in it now, but
you're right.
It's not it's a slowdown if your neighbor loses his job. It's a recession if you lose your job. And once people do start losing their job or jobs, because a lot of people are working more than one, or their pay gets cut back or no bonus or stuff, that's when it really gets stressed. Because right now it's just getting stressed because payments are going up on stuff. And again, like if we get a sharp downturn in Canada, it's going to be one of these moments where people say, oh yeah, we all knew it was going to happen. But as of right now, nobody is saying it's going to happen. So I just think, from an investment perspective, we're pretty, you have to be ruthless as an investment manager. You have to be insensitive to feelings and all that stuff. But this is one of the best setups that we've seen in a long time, from an investment perspective. And that's where we're going. Do you guys want to talk about the ECB this morning or the US data?
Your favorite central banker, Keith, get into it.
Yeah, there's lots of interesting things. But very quickly with the Europeans this morning, what did we call the American hike last week? A hawkish hike?
No, hawkish pause. No, panic pause.
BOC,
no, that was the BOC.
Pause.
BOC was panic pause.
But the Americans today a hawkish hike.
Hawkish hike. No,
you're correct. Yes, they did.
The Fed's next
that's
week,
right.
Aren't they?
Yeah. So this
Fed's
morning,
next week, I thought the Fed's on the 20th.
Oh, you're right. Yeah, that's right.
You okay, Boomer?
Here's. Apparently, I'm not. Right. However, the Europeans this morning. Now I sound like a European. I'm all waffling all over the place here. They did a dovish hike this morning.
That's right.
They hiked by 25 basis points. The market was sort of 50-50 on it. And but what they did, the reason why is dovish, and what dovish means in our world, everyone, it means that you no longer have a strong outlook for stuff. So you think growth will be weak, inflation will be weak, and therefore you may not have to raise interest rates again. So with the Europeans this morning, it was very weak. So to be specific about it, they see inflation slowing to 2.1% in 25. And they cut their growth forecast for next year and the year after. So again, they're painting the story that market conditions are now sufficient to bring demand down. We saw Germany, even the German government now is starting to forecast recession coming up. But that was the European story. And, the euro currency today is getting what? What's their favorite word?
Mullered.
It's getting mullered. Absolutely mullered.
Isn't Germany already in a recession? Let's be honest.
Yes, they are.
Yeah, I would agree with that.
Unemployment's going up and quarterly GDP growth is negative for 2 quarters in a row.
One of my good friends, he's he runs money over in Milan. And he shared some interesting thoughts this morning. So apparently at Jackson Hole a couple of weeks ago, I don't think this was broadcast. If it was, it didn't get leaked out very much. Christine Lagarde let out some pretty interesting comments. And so I just want to share with you. She it says here, like, she stood in front of the large audience of elite central bankers. Are there any non-elite central bankers?
Yeah, Tiff Macklin. Macklin. So I can't say his name probably, but that guy.
So for all the listeners, every now and then I like to set Rich up for a good little one-liner, and he pulls them off every time.
Bites.
I know, he always bites all the time. It's good to get him going. Anyway, Lagarde, head of the ECB, she casually predicted the collapse of the international financial order. So let's say it again.
How does
she casually predicted the collapse of the international financial order, which is the global, financial system and all this stuff.
Hey, we
So
should get
there's
her
a
on the
couple of
pod.
yeah, but there's a couple of things with Lagarde. You have to appreciate. Remember, we should, I mean, we like to joke, of course, but we should never really critique the heads of any of these policy groups because they have the role in what they're doing. So whereas a lot of central bankers, they're the voice, they're the ones contributing to the policy move, stuff like that. Lagarde is not in that position. She's the mouthpiece for other groups who are very much involved.
But she used to be head of the swamp, no?
I think the swamp extends to the central bank world. To be
So
fair,
she was a head of the IMF for those not aware of that.
but even when she was ahead of the IMF, like she was quite honest about it. She said, I'm just representing, a group that's making decisions and stuff. But for her to come out and say that, it does imply that the conversation is out there that, and this is what we talk about quite a bit. We are at this moment where something will happen. And in our view, it is on the debt side. And I think everything is linked together. Like the shirt, say no to central bank digital currencies. It doesn't matter how many shirts we wear, guys. It's going to come anyway, right? So, but that was
not with that attitude.
Wait a second. Counterpoint to Christine Lagarde predicting anything is that she has a horrible track record of predicting stuff. So I think it's important to keep that in mind.
Maybe. However, the point is, here she's head of one of the world's premier central banks. And she's actually using that language in front of a big audience. And again, it's not like, they're not at the pub having a pint or anything. Like this is big stuff that's happening out there.
I know, but she also said that it was going to be a little bump in inflation and it would be gone in 2 months. And she meant that as much as she means about this, if not more. So I'm just saying it's, let's keep,
yeah, but talking
future's
about
hard to predict.
Inflation is one thing. Talk about, hey, the global system it could change. It's two completely different stories, Rich. Like it's a big deal that's out there. But that's something that really jumped out with my friend who manages money over there in Euroland. So what else do you guys have there?
We got the US CPI. I don't know if you guys want to chime in on that. I mean, I feel like oh man, I feel like we've been talking about CPI for like 101 episodes now.
I've got one quick thing, which is the energy. We talked about that and warned about how the energy base effects are now going the other way. I think you'll be happy to know, Keith, the WTI hit $90 the other day, following Brent higher and higher. The gasoline prices, they call it fuel oil, gasoline, 10%. They were up month on month, if I'm not mistaken. So that's a huge change, basically. Shelter component also continued to rise. Not much on that, but it is interesting. The headline, I think, was up. So just keep an eye on that. I think
the big news this morning. I mean, we had the American retail data.
Yeah.
Then we had the PPI data. Do you guys want to go into that like loosely without going to all the deep numbers? Because it does tie into that hawkish hike that's coming in.
Just to Rich's point, I totally agree. Obviously, with the gasoline prices, obviously pushing inflation higher from a base effect, and I think we're going to see the opposite on the base effect side from the rent side. So CPI reported rents being up at 7.8% year over year, but if you look at any sort of real-time data analysis, Zillow, Redfin, apartment list, where US rent growth is pretty much running at zero at the moment. And there's a lot of analysis to suggest that rent growth could turn negative on a national basis next month. And in fact, in many major metros in the US, it's already happening, which is kind of interesting because it's definitely the opposite of what's happening in Canada. We're still seeing rapid rent appreciation, which ties into our whole conversation with Ben Rabidoux. So anyways, that's the other flip side of the US CPI. So it's funny to see, like on Twitter, as you're seeing both sides, like the inflationists and the disinflationists guys arguing back and forth. One talking about gas prices, one talking about shelter component, and how that's all going to play out over the next 6 months.
Before you go on, Keith, before you go on, just remember, just for people to remember that there's core which excludes energy and food, and headline, which is the entire basket. Sorry, that's why there might be conflicting sort of views. And sorry,
Which
Keith,
is
go
weird,
ahead.
hey? Because who eats food and drives a car? It's the stupidest thing ever.
I eat bugs. Anyway.
Hey, eat the bugs. The guys, the Canadian inflation is next Tuesday, I think. So we'll have that next week. The other item that was jumping out at me,
Retail
Canada
sales.
CPI. We should almost have a prediction for that. There's a lot of. I mean, we talked about.
Oh yeah, it's my CPI comment. Yeah, absolutely. It's actually pretty smart. As opposed to the other comments we usually make. What I suspect will start happening now with CPI data is that analysts have now, like, analysts are always slow in developing the trend with estimates. So when inflation data was going up, their estimates were too low. And now that inflation data is rolling over, they were slow to react to that. And now all of a sudden, I think you're going to see them overestimating the lack of growth in CPI. I know I messed that up with numbers, but let's just say they're estimating CPI to be 3%, and the number will be 3.5%. Or if they're estimated to drop to 2%, it'll only fall to 2.5%. I think that's going to start playing in. And then that will then start to kick off the story that, hey, maybe there might be more rate hikes, or there won't be a rate cut. Remember, the market will always over and undershoot itself. Quickly, guys, you want, like, with the American retail sales number this morning, almost every single data point came out. It was strong. So again, these are just the headline numbers without going to the weeds. But it does demonstrate that the American economy, it's resilient. That's a cool word, but it's strong. And then also the producer price index data was another way to measure inflation. That was also strongish as well.
Do you think deep down, like, I don't disagree with you, like the headline numbers are obviously, everyone's, surprising to the upside, but when you really unpack it, are you really that bullish on, like, the US consumer? I'm just genuinely curious, because it's interesting because you hear these things of, like, auto loan delinquencies hitting the highest level since the GFC, credit card balances being carried over into the next month, like the highest that we've seen since 2008. Like, all these metrics are kind of like screaming, okay, underneath the surface. And then you've got, of course, the headline numbers come out and they look pretty good on the surface.
Now, I just think that it's a lag right now. I mean, so European growth is rolling over, Canadian growth is rolling over. The Chinese are having problems. If you with the Americans, they're probably 1 to 3 quarters away from starting to to show that kind of weakish growth. It's very difficult for one major economy, which is a consumption economy, to consume. They need to borrow and all that stuff. It's unlikely that the Americans will pull everyone else out of it, as opposed to the opposite. So that's what I suspect. It's where we're going with that. Speaking of China, what did they do this morning, Rich?
They cut repo rates again. Yeah. We've talked about this. They eased again. This is a path. They've cut reserve requirement ratios. They've reduced deposit interest rates. They've reduced repo rates.
And why are they doing that? Why are they doing that? To share with everyone.
Well, this in conjunction with some kind of government spending program is to provide liquidity and basically easy monetary policy to soften the blow of effectively I wouldn't say crashing, but a real estate sector that is under immense pressure. You can see this in the bonds that are trading at 20 cents on the dollar in some cases. You can see this on the stocks that in some cases have gone bankrupt. I think some companies have gone bankrupt. Equities are down 75%. That real estate sector is going to be a huge drag for a long time. And they're going to have to come up with a way to sort of deal with it, either through a bad bank, which happened in Europe in 2014, 15, or I don't know how else they do it, or just handing people cash or something. I don't know.
What would they call the bank? What would they call it?
The Panda Bank. I don't know what they would call the bank. But
for that equivalent,
Oh, sorry.
For that equivalent story in Canada, it would be like the Bank of Canada cutting rates. The commercial banks are lowering the cost to borrow, so mortgage rates and everything like that. Like anything to try to get demand for credit to come back.
Yeah.
It's like, leading the horse to water. Like if it ain't thirsty, it ain't going to drink.
Well, that's what's so
China
interesting.
Is a real problem that they have over there.
What's so interesting about leading a horse to water? I mean, not to call 1.3 billion people a horse, but there's definitely a switch in psychology there. People no longer. I mean, again, it's difficult for us to say sitting here in Canada to what the psychology is of a bunch of people in China, but there's if you read enough articles and you can see people have definitely soured on that financial asset as a means to save for savings or for growth or to generate some extra income or what have you. That there's definitely been a switch in that psychology. It hasn't happened here, I don't think, in Canada, but maybe next year.
Yeah, because they're ahead of the cycle, compared to us, as an example. And by the way, they're not leading the horse to water.
What? Who are they leading?
Looking for on the
they're leading something else to the water.
So it's U.S. credit card balances have exceeded $1 trillion this year for the first time ever. And so simultaneously, for the first time in history, over 50% of credit card balances are being carried over from month to month.
So you have to be careful, though, with that, right? So that is true. You can't deny it. I think 1.1 trillion, I think, is the credit card number. But as a percentage of GDP, we're very, very low. I think the issue with the U.S. Is really the haves and the have-nots. So if you look at delinquency rates for credit cards of the top 100 banks and the bottom banks or other banks, so in America, there's 4,800 and whatever banks. The top 25 of them have an incredible amount of assets. And they're also the ones that serve wealthier people. Let's just say broad stroke. So you got the JP Morgan and Chase with the Black Card or American Express, or whatever it is. And so those people have very, very low delinquency rates. If you go in, there's loads and loads of regional banks in America, and those regional banks will offer credit card to, in general, it's not always true, but in general, lower income people. And that's where you're really seeing the charge-offs or write-offs, or whatever they call it, and delinquency rates rise. And so the chart is these jaws where you have these people who, for example, have locked in mortgage rates at 30 years. They're not delinquent on their mortgage rates. That's not happening at all. But people who don't necessarily have a home, they're defaulting on their credit cards and their autos. And again, it's bifurcated. There's two groups. There's like the old people who are not doing that and young people. So the delinquency rates for autos and credit cards, it's basically all people under the age of 40, over the age of 50, like our boomer here, there are no delinquency rates. So it's really split, and you have to be careful.
So what you're basically saying is inflation is crushing the lower middle class.
Always has. Who was the central bank? Who is the guy who won a Nobel
Paul
Prize?
Krugman.
Yeah,
Paul Krugman. Yeah.
What a jerk that guy is.
Let's not give him any airtime. Let's not even.
Sorry, that's not even so.
Someone,
inflation is bad.
Who aren't aware. Someone roll up the Paul Krugman quote.
So he won a Nobel Prize for economics a few years back, and he's the socialist mouthpiece for the New York Times, and he just wrote a piece to say inflation doesn't hurt any social economic group any more than another one.
Which is absurd.
I read this, I'm like, are you insane? Are you crazy? But and other people agreed with my view as well.
The ivory tower there.
It's an outrageous thing to say for someone of his position, to be honest. But anyways.
Speaking of outrageous, apparently in Canada now, they're recommending people wear a mask again. So this is something we talked about. And this isn't, we talked about this first last week, which is going. But again, this is the step we're going towards. So they floated this. You guys laughed at me last week, and here it came out right away.
I just don't want to get canceled. That's all. I know you were right.
Well, we won't get canceled, but the next step, you're going to see schools making it mandatory or strongly suggested, and universities. By the way, I go into one of the local universities every morning to grab a coffee and a lemon loaf. And there's a sign there, like the stand-up sign, and it used to say masks are mandatory, and then now it's like masks are recommended. Yeah. Every time I walk in, I always turn it around.
Turn around, drop a
Oh,
wrap,
boy.
and leave.
Yeah, no one cares, right? I do that. But from an economic perspective, if this continues the way, I don't want it to, but I can see it happening, you're going to start to see, hey, to encourage everyone to get tested again. Like in here in Halifax, when COVID was raging, the government they didn't require it, but they strongly suggested they would really love everyone to go get tested. And my God, they were lined up, zigzagged around the blocks to get tested for this stuff. So down here, they're really into it,
They love it.
and I think they'll do this again. And if you are testing positive, you have to stay home for 5 days or 10 days. So think now, if you're an employer and all this stuff is happening again, I'm telling you, we're headed very dangerously towards this, COVID 2.0 version. I don't know what it's going to look like, but it's not positive, for the economy.
Hey, that's one way to get rates back down. Housing bull market is back.
Yeah.
Pandemic 2.0.
Another tinfoil hat gang coming out with your Mexican alien now. And they're just going to wrap up the show with the alien in Mexican Parliament.
Get your suburban house while you can.
Oh, boy.
And I think we know as well is what the G20 communique agreed upon there last week. What they included in one of their conclusions, everyone is united for central bank digital currencies, though everyone is encouraged to start building the necessary infrastructure, as well as with digital IDs. So again, we are continuing to go down that path, whether people like it or dislike it or couldn't care less. But it does have a lot of economic effects on us, as well as going to be some pretty strong raging social reactions to this stuff.
I was just going to say, to kind of wrap up the show, I actually think it's the social...
Did you say rap? Did someone say rap?
Oh, no.
The social side of it is going to be interesting. I just there was just scrolling through Twitter today, seeing some of the CBC reporters tweeting about all this COVID stuff like that Keith talks about that's starting to flare up, and everyone's freaking out again. Just seeing like the ratio on some of these tweets. From you read the comments and people are like just livid, like attacking these reporters, and like I don't know, it's interesting just from a social perspective. I'm not saying whatever way you lean on the mask side or no mask side. I truly think people have had enough, but we'll see. Tensions are rising, and you've got still high inflation, lack of affordability. Insolvencies are rising. Masks are coming back. Oh man, I think pitchforks are coming out.
You'd think you almost think they need a distraction away from other deteriorating events.
Yeah, the NHL hockey season, and football. Football.
Okay, guys. This
What's your
week,
prediction?
the 49ers are in LA to play the Rams. So last week, my score was almost dead on my prediction.
What was your score last week?
I had 37-13, and it was 30-7 in the end. So this week, it'll be the San Francisco 49ers 41. The LA Rams will score a late touchdown to make it 13 points. So 41-13. Go Niners.
Is the San Francisco 49ers, are the artificial Loonie Hour team? Do we have, I think so.
I think that's a good idea.
I think we should adopt them. I think as their Loonie Hour.
Okay. 49ers.
Go. The next Loonie Hour event should be at Levi Stadium. Let's set it up.
The halftime
awesome.
show. That's a good place.
What
to
a
wrap
dud
it up.
that would be.
Did you say rap?
Sponsored by JM Smuckers Twinkies.
That's right.
I'll as always, we appreciate the support, and we'll see you next week.